Is this going to be the worst year on record for the stock markets, or are bearish views and concerns slightly overblown? Well, we're here to discuss this with David Barse. He is the CEO of XOUT Capital, and XOUT Capital manages a fund that eliminates what the fund manager, David Barse, believes to be the laggards of the market. David, welcome back to the show.
David, thanks for having me, and Happy New Year to you and all your viewers.
Happy New Year to you as well. We'll be discussing XOUT Capital's latest rebalancing from a few months ago, as well as your views on the markets at large. But first, I want to get your take on what's been happening with stocks over the last week. So as you know, the S&P 500 has declined a few percentage points, 3.5 to be exact, over the last 5 trading days. Is this a cause for concern for you?
No, I mean, if folks are spending time worrying about what's happening day to day, then they shouldn't be investing in the stock market. People need to take a long-term view on investing in all asset classes, but especially something like the U.S. large cap marketplace, which is what we're focused on. And what we're focused on is long-term secular decline. What this kind of market environment provides for us is an excellent entry point. I can't tell you how many conversations I've had with prospects and clients about how expensive the market is. And boy, I wish I invested in your strategy when you launched it. Oh boy, I wish I invested in it at the beginning of 2021. Well, guess what, folks? The market is handing you a softball for entry. So let's talk about it.
Softball for entry. Well, a few percentage points is not really a significant bear market yet. That's what some might argue, because we could see further downside, or this could just be the end of the dip. So if you're on the camp that we're going to see more of a downside, I mean, shouldn't you wait?
Well, you had a viewer on last week, I think, who said he didn't like dealing with averaging down. No one, or very few people, are successful on picking bottoms and selling at tops, right? So you can't get that right every time. If you get a market like this that has adjusted in such a short period of time and has dragged down high quality, well-financed companies that are growing their earnings, that are profitable, that are using their resources from cash flow to buy back their own stocks, and those stocks are being handed to you on sale, buy them today, and if they get cheaper, buy them again the next day. It's not like this is the end of that buying opportunity, but I suspect until we see new fundamental data, which is coming in the next couple of weeks as companies announce their fourth quarter earnings and provide you with little insights into what's going to be happening in the future, boy, will people be really happy they listened to me.
Well, let's talk about valuations. You brought up an excellent point. So valuations are a concern for a lot of investors on a price to earnings perspective. One could argue that they have been the most expensive that since the dot-com bubble, actually since the great financial crisis. So do you think that valuations are going to keep rising, or do you think that there's basically two camps here? One that thinks valuations are not really a cause for concern. Valuations are not a leading indicator for prices, meaning that just because something is expensive, it doesn't mean it can't go higher. That's one camp. The second camp is that valuations are overblown, they're overstretched. One economist we had on the show recently said that they're orchestrated by central banks. This is a bubble that needs to pop. It's going to collapse by up to 90% was his view. So which camp are you in?
Yeah, I'm probably somewhere closer to the first camp, but in between, in the sense that when we use the word valuation, we're talking about metrics that have been the historical basis for evaluating market prices. And what XOUT is all about is one of the most significant forward-facing risks that all companies are dealing with, and that's technological disruption. And what technological disruption has shown to us over the last couple of years is that valuation doesn't really, in the historical, traditional sense, really matter that much, because the paradigm around how one evaluates or values a company has to change. Using simple price to earnings ratios or price to book ratios and calling things expensive isn't really appropriate anymore. And companies are changing by the day how they're evolving. They're adjusting to this technological disruption, and impacts to things like intangible assets and goodwill, which have traditionally not been used to value companies, have now become more significant in the way in which one should look at a bargain. And I'd argue for you that some of these mega technology companies, which continue to transform their businesses, which continue to grow earnings, which continue to invest in their companies, which are not loaded with debt, have found ways to circumvent these traditional historical financial tools. So let's talk about what's really expensive. And I'm telling you that my view is these are not expensive stocks. They're great companies to own for the long term.
So David, with tech stocks having grown tremendously over the last year and a half, do you think now is the time for a sector rotation, for capital to rotate out of growth stocks and perhaps into value stocks?
I don't think the growth value dichotomy really exists. I came from the world of being a value investor and a deep value investor. And what we always said was, if we found a good company, it was a growth company, because good companies figure out ways to continue to grow, to become profitable, to invest in themselves and transform as the market transforms. To say that there's going to be a rotation from growth to value when value companies aspire to be growth companies is, I think, a misappreciation of the dynamic that's really going on. And again, what XOUT's trying to do is eliminate those companies, the companies that aren't growing, the companies that aren't investing, the companies that are highly leveraged, the companies that can't figure out a way to make a profit. If they're in the S&P 500, they're dragging down your performance if you own that broad-based index. So just get rid of them, eliminate them, let XOUT do that for you.
Your company is pretty heavy in tech right now. We'll leave a screenshot of your top 5 or top 10 holdings. It's quite clear that you have a significant weighting in tech. Are you not concerned that potential rate hikes may adversely impact tech valuations the most?
No, because again, we're back to talking about the same topic. Valuations of what? These companies are continuing to perform. They're excelling at what they do. They're growing each and every quarter. And what they're thinking about is not this quarter's earnings or how it might be evaluated against a rising rate environment. They're thinking about 3 to 5 and maybe even 10 years from now and what their businesses and companies are going to look like. And that's what they're spending their time focused on. They let guys like you and me talk about the day-to-day and probably laugh at us when they watch this interview, because they're really thinking about the future and how they're going to transform their business in an environment that's transforming itself every day.
Mm-hmm. Okay. Well, let's talk about valuations and let's talk about metrics for valuations. I'll tell you a personal story, David. A couple of years ago, before I joined Kitco, applied for a hedge fund. I didn't get the job, which is, I guess, why I'm here talking to hedge fund managers. But one of the questions for me was, how would you value this company, this particular stock that you're pitching? I pitched some EV, traditional metrics: price to book, price to sales, price to earnings, EBITDA. And the guy asked me, why are you using these metrics? Well, I guess because everybody else uses them, right? So if you're not using these metrics, what else are you using?
Well, that's what you get taught when you go to business school, and
Yeah.
those are the traditional valuation metrics. But I think in today's world, you have to start focusing on some of these other metrics. Again, I talked about intangible assets. How do you truly weight the value of a patent? How do you truly weight the value of a company's goodwill when they're able to build a franchise like Amazon? It's not necessarily weighted in the traditional form. Most of the analysts will out there say it's trading at some crazy multiple of next year's sales. How can we think this is a cheap stock? But it's not accounting for those, let's just say, less traditional metrics that are used. Tesla's my favorite one because everyone keeps comparing Tesla to other large auto manufacturing companies like GM and Ford and claiming that it's wildly expensive, but they're misanalyzing what Tesla is. Tesla is a very different company than Ford and GM. And for analysts to try and make that comparison seems foolhardy to me, but that's what the market continues to do. And they talk about it all the time. So I think we just have to adjust ourselves in technology and what the disruptive effect it's having on all businesses, and start weighting these alternative valuation metrics with a greater weight than just relying on a price to book or price to sales.
I think when sometimes people are saying stocks like Tesla may be overvalued, I'm not saying it is, I'm just quoting some people who may think that it is overvalued. They might be using the argument that analysts' forecasts for future sales or future performance, those projections are maybe a little bit aggressive. Maybe there's too much hope around what Tesla can deliver as a company in terms of its production of sales, production of cars that it plans to roll out in the next 5 to 10 years, and also what it hopes to do for the future of renewable energy. So if you take a look at not just Tesla, but other stocks in that sector, do you think that the future projections are based conservatively, or maybe they're too aggressive for you?
No, again, I think you're referring to projections based upon traditional auto manufacturing metrics that are used. How many cars are they going to sell in order to back into a stock price and provide a present value analysis for that and compare it to the others, and then therefore you get your, wow, this stock is wildly overpriced. But where in your analysis are you accounting for all the data that Tesla's accumulated in every one of its vehicles that's been driving on the roads for the last 10 years, right? Where is that in your analysis? How much weight should you apply to that? What's the use value for that data? And I would say that many of the traditional auto analysts probably have provided little weight, if any, to that kind of metric. What are they going to do with that data? It's kind of the story of Amazon. For many, many years, it was a bookseller, and no one really appreciated this little investment they had made in their cloud services that they were going to provide, their web services to companies and clients. And all of a sudden, one quarter, they read, oh, look at the contribution that this is making to their enterprise. And now the valuation of Amazon's web services division is, what, 10, 20 times greater than what the company was worth way back when people weren't even giving it any weight. So people have to open their minds up a little bit to what the future is likely to be and how disruptive these technological advancements are going to be, and change their whole analysis. So that's our argument. We're not trying to figure out who the next Tesla is. We're just telling you probably don't want to own GM and Ford in the S&P 500 and let a company like Tesla take care of itself.
Okay. Well, let's just look at your fund now. The funds, the stocks that you've eliminated, yet that you've X'd out, these are companies that you've deemed to be laggards. Now, can you define that for us? Are they currently lagging, or do you think they will be lagging in some capacity?
No, so it's the test that we use, right, is a 7-factor test, and it's measuring the company's last quarter's results against its previous period. So it measures each company on its own. So let's pick on AT&T, one of the larger cap names that we've X'd out. We look at AT&T's current quarter's performance against its own historical performance, and then we allocate a score to that. And if that score is in the bottom 250 of the 500 largest U.S. market cap names, it gets eliminated. AT&T's score has been miserably low since we launched our strategy.
Yeah.
Why? The company's not really growing. The company hasn't been very profitable. The company has massive amounts of debt, and therefore, if it buys back its own shares, it uses borrowings to do that. That's a big negative for us. The company isn't adding to its labor force. It's eliminating labor force. So there are a number of factors that we look at that looks at AT&T, again, its own performance, but then measures that in a scoring system against the other 499 names. Compare that to a company like Amazon, which has been in our portfolio since inception. It continues to score extremely well in all of its metrics. And it's very unlikely for us to see that company ever get eliminated based upon its performance. Now, it could have a horrific quarter, and the world could come to an end, as some of your other commentators have offered, and we could see its score go down substantially. But if the world comes to an end, all the other companies' scores are going to go down too.
Yeah.
And on a relative basis, it's going to be really hard to X out a company like Amazon. But it's possible. It's theoretical.
Some of the qualities that you've listed in your criteria are just that. They're very qualitative. They're not entirely quantitative. So let's talk about the quantitative side. Let's talk about if I were to give you a stock, any stock, and I were to give you just the three statements, the income statement, balance sheet, the cash flow statement, if you were to tell me the top three things that you will be looking for first, before you even look at the notes, the financial statements, just the three statements, what would those three things be?
Yeah, I mean, first of all, revenue, top line revenue is the hardest factor or entry in a financial statement to fudge, right? A lot of companies, you mentioned one of your hedge fund interview valuation metrics was EV to EBITDA, right?
Yeah.
EBITDA used to be, I remember reading an article years ago when I was a young analyst, and it was EBITDA is king, right? But EBITDA is one of the fundamental metrics that can be fudged. In other words, there are so many ways in which a company can manipulate its reporting of EBITDA.
Right.
It's very hard for a company to fudge revenue because it's a simple top line thing. Now, some companies have tried to do that, right? They recognize revenue that might be in the future, but they recognize it today, right? So other than those kinds of things, which we try our best to weed out, revenue is for us the most important thing. But then we also look at profit, and profit is also a little bit more of an important metric than EBITDA again. And then we look at hiring and sales growth, growth in labor force. That's another one which is, again, important measurement to see growth. We let the sell side have a little bit of influence on us by tracking the performance of companies' earnings and their own forecasts. And we let the sell side community, in effect, rank that for us, because companies that have had success at reporting earnings and then forecasting their next quarter's earnings, providing a so-called guidance, right? And then how well have they performed against their guidance?
Right.
So that's an important, I believe it or not, that's actually a pretty good factor for us. We've had some good results with that. And then lastly is the investment in their company. Of course, buying back their own stock or making investments in research and development, to the extent that that's reported with clear lines in financial statements, those are very important metrics for us. So that's what we use from a quantitative standpoint.
What about leverage? Let's say a company has very good scores on all these other criteria that you mentioned, but most of the balance sheet is just debt. How would you approach it then?
Yeah, they tend to get dinged because the way we weed that out is in if the investment in buying back stock. A lot of companies do use leverage as a tool to make their own investments. If they think it's a prudent time to buy back their own shares, they'll tap credit lines in order to do that. Some credit lines permit that. And so that's one of the ways in which we weed that out and they get dinged with a bad score.
Okay. Very good. Well, looking forward then, your overall market outlook, we coming back to this, you mentioned that you're somewhere in between a 90% crash and perpetually growing to infinity. So what does that mean? That's a pretty broad range.
Yeah. Well, you set the bar so wide, you can easily jump through that one. But no, I am an optimist, an eternal optimist. I believe that the equity markets are going to perform positively again this year. I believe that the large cap U.S. equity space is the best place to be in the world, that companies will continue to generate good positive earnings growth, and that notwithstanding the tapering and what the Fed needs to do to normalize, and hopefully we don't have yet another variant that will impact or impair their ability to normalize. You're going to continue to see good positive performance from good companies. You're going to see some of those companies that are struggling with these forward-facing risks of technological disruption continue to lag and lag worse. So in this interim period where you have so-called market rotations going on, let the traders have fun with that, and hopefully they're on the right side of those trades.
Yeah.
But for me, it's a long-term secular decline that we're seeking to avoid. And XOUT's been able to do that exceptionally well in its first 2 years of life. And we expect that we'll be able to do that again. So I'm looking for, a positive year on the S&P, or for us, the large cap U.S. equity space. Mm-hmm. And I'm fairly confident that's going to happen, especially since everyone seems to have forgotten that, at least in the U.S., there's been a big infrastructure bill that was approved that hasn't even started. And they're going to start pumping money into businesses all across the United States, especially to improve our broadband capabilities. How is that not going to be positive for technology companies? So, let's not only focus on negatives because that's what everyone wants to talk about today. Let's think about the long term, but another positive year. So let's get Mr. Grandage back on, and him and I can have another discussion, and hopefully a worthy debate, and maybe even a wager that will help support philanthropic things that we both do.
I'm sure he would appreciate it. And for the record, he did pledge to donate. I think it was $1,000 to a cause of your choice, and he did, right? He did. He made good on his wager. This is a very honorable and high quality man. So very much appreciated that discussion, and I hope we can discuss it again, because he has important views that all right.
Even I respect the opinion about what he has to say.
Well, I'm sure he has plenty of good things to say about you as well. So yeah, we'll definitely organize that panel again. And thank you so much for coming on today and giving your views.
It's always a pleasure, David. And just remember, it's more important what you leave out of your portfolio than what you put in.
Yeah, I think that could be applied to all areas in life, not just finance. But yes, you're right. Thank you very much, and thank you for watching Kitco News. I'm David Lin.